Hi again. So we are going to discuss share price valuation, the concept of share price valuation, on what basis you are going to find the intrinsic value of a particular share at the moment. So what we are going to do here, we are going to solve say 5-6 problems here to understand the concept. And the first problem is pretty straightforward. It asks us how much you think is a fair price of this particular share, which we after 1 year intend to sell for rupees 33, and this share is going to pay us a dividend of rupees 1.5. So this is a formula to solve this particular problem. Basically, you have to know the present value of all future cash flows. So there are two future cash flows. One is a dividend 1.5. You discount it by say 12%, 20% rate of interest, which is given over here, and the selling price, which is your capital gain, which is also supposed to be discounted by a 20% discount rate. And summing it up, your share today is worth 28.75. Pretty simple. So uh, this is how, with a given dividend and a given horizon of selling price, you can find out the fair price today. Now, in the second problem, we move on to build up the concept, and here what we find is you have most recent EPS, the most recent earning per share of the stock has been given, which is 1.6. Out of this earning, 50% is paid out as dividend to the shareholders. The growth rate is 8%. That means this earning of 1.6 keeps on growing every year by 8%. The price to earning ratio is 12%. Sorry, 12. Multiplier is 12. We intend to hold this stock for 3 years. After 3 years, we would like to sell it off. And what this stock should be worth today if the discount rate is 10%. This is a finite case, means after 3 years we are going to come out of our investment, and it's a 3-year period. So it's a finite case multi-year period problem. So what we have been given here, that the dividend, the most recent dividend was 1.6 multiplied by the payout ratio is 0.8. Right? EPS multiplied by the payout ratio is 0.8. So we got rupees 0.8 or $0.8 as a last dividend. Now, again, the basic concept remains same. The fair value of the stock today should be equal to the present value of the dividends plus the present value of the final selling price of this stock. So present value of the dividends means we are going to have how many dividends in 3 years? First dividend at the end of first year, second dividend at the end of second year, and a third dividend at the end of third year. So for these three dividend, we can easily calculate how much will that dividend be, because dividend is a fixed percentage of your earning, because payout ratio is fixed. And the first dividend, the most recent dividend, keeps on getting growth, keeps on getting grown by 8% per annum. So this will be the first dividend, 0.8 multiplied by 1 plus 0.08. Then again you multiply that by 1.08, you get the second dividend. Again you multiply that by the 1.08, you get the third dividend, right? So now we have got all the three dividends, right? And we know the discount rate was given in the problem as 10%. So we can discount all these three dividends, right, with 10% discount rate, sum them up, and that gives us the present value of all the dividends. So here what we have done, we have done this first part, present value of the dividend. This particular part we have already done. Okay, so let us move further to find the final selling price. So for the final selling price, the formula goes like this, right? V0 is the final selling price of this stock. It will be price to earning multiplied by E0, the present earning. So this is basically nothing but you can say it P0, the present price, right? So if the stock is so the company is growing, say at rate G, its price is also supposed to be growing at rate G. So this P by E multiplied by E0 multiplied by 1 plus growth rate of the stock raised to the power n. For the year we want to hold this stock, divided by the 1 plus k raised to the power n. So this is a present value of the final selling price. So this much is the final selling price, right? And you discount it with the discount rate k, and you get the V0, the present value, the final selling price. So this is nothing but finding out how much is the E3. So this is basically EPS 3. What is this? This figure is EPS 3, right? So if you want to find out EPS 3, this is the way to do it. 1.6 was the first E0 EPS that over a period of 3 years became 2.02 because the earnings are growing at a rate of 8%, right? And then you plug that EPS 3 into this V0 formula like this, and you can calculate E0, which comes out to be 18.21, right? So this is the present value of the selling price of the stock. So this is like our capital gain. So when you sum this up with the present value of all the dividend cash flows, you get the fair value of the stock, right? So hope this is ample clear. Now we move on to the third problem, which is an infinite case. So infinite case means I'm not going to sell my stock. I'm going to keep my stock till eternity, right? And this is stock recently paid a dividend of rupees 2. This stock is having a growth rate of 9%. The earnings are growing at a rate of 9%, and the market discount rate is 12%. Now, what is a fair value? I don't want to sell this stock. I want to hold it till eternity. Now, what we do, the formula is even simpler here. The present value of this stock, because there is no capital gain. I'm not going to sell it at any point of time. So whatever V0 is going to be, this is going to be the final value of your dividend cash flows, which you are going to get till t is equal to infinite. So so which dividend actually grows further? The dividend D1 at the end of year 1, not the dividend D0 here is to be taken into account, right? Because your period infinite will start from D1. So what you get as D1 should be the D0, which is 2 here, multiplied by the growth rate 1.09, and you get D1. And you are now, it's a perpetuity case. So what you do in case of perpetuity, you divide it by the rate of interest. So the rate of interest again here will be modified because there's a growth rate attached to it. So this is a market rate and this is the growth rate. So you reduce the growth rate from the market rate, and then you arrive at a fair value, which is 72.67, right? So this much for a perpetually held stock, an investor should be able to pay for this. Okay. Now we move on to our next problem regarding share price valuation, and this is even more simple. So what's being asked here is that we want to find, it's again an infinite case, but then this is a case where the stock first grows, say, super normally, something like this, exponential growth, and then say it's like a normal growth. So there are two periods to it. One is super normal and another is normal growth rate. So both the growth rates are given. So recent dividend, same as earlier, rupees 2. The supernormal growth rate for the first 5 years, suppose this is a company which is growing super fast for the first 5 years at the rate of 20%, and thereafter it becomes like any other normal stock in the relevant industry, which is growing at a rate of 10%.